So give us a sense of how you're putting all these little threads together, Neelkanth.
The Indian economy, I think, is rebounding very well from what was primarily a lockdown-driven recession. And I think the medium-term growth outlook is also improving. There are several important policy changes that have occurred. For example, the production-linked incentive scheme is the first time that the government of India is backing companies, giving them production targets, and putting money behind them. And that improves the medium-term outlook for India. At the same time, we recently discovered that there are 100 unlisted billion-dollar plus companies in India, not just in the tech space, which you would expect, like the e-commerce and the edutech and the fintech, but also in consumer goods, in logistics, in modern trade. And this is, just to give you the context, in the listed space, there are only about 336 companies with a valuation above $1 billion. 2/3 of these 100 unicorns have been started after 2005. So India is going through a phase where there is a lot of new company generation. These companies are seeing their environment to scale up, and I think that's great for the medium-term outlook for the economy.
Well, Neelkanth, of course, technology is the mainstay of those unicorns as well. And what COVID has done is accelerate some of the trends that were there before. So can these unicorns help to drive India forward? And does it represent an inflection point for the country?
I think it does. So in many of the sectors, so the good thing about these 100 unicorns is that they are in a very diverse range of sectors. So there are companies in software as a service. So this is India's transition away from pure services to getting into products. And if you talk to some of these companies, they've kind of stumbled into this software as a service theme. I think the number of unicorns in SaaS can actually quadruple in the next 3 to 5 years. These companies are generating very high value jobs. In the pharmaceutical space, you just had a speaker before us. The ecosystem is now matured. Now the companies have R&D budgets going into $200, $300 million. They're getting into innovative products. In the technology space, I think the spread of fintech is allowing a lot more companies, a lot more businesses to get access to credit, which was not possible without technology earlier. So I think it is actually a very important part of India's growth prospects in the next 5 years.
Well, Neelkanth, there's an old saying about India, isn't there, that India's got a great future, and in 10 years' time we'll be saying India's got a great future. Missteps by policymakers has been one of the biggest problems. How do you guard against that?
So one of the risks, if I was to highlight one, is the shortage of capacity in the financial system, right? And it is quite possible that India's rate cycle, and you did mention bond market volatility, that the tightening of rates could actually happen prematurely, even before the Indian economy has finally, sort of got into the runway. And so that's definitely a risk. But I think the way the market is structured, so while that may be a marginal risk for the economy, the way the market is structured, a very large part of the listed space is actually the private financiers, not just the banks, but also the non-banking companies. And after a 2-year lull, some of these companies are finally starting to get some funding. So so long as we are invested in the firms that are likely to drive whatever growth there is, I think the risk of very sharp negative surprises becomes very low.
Neelkanth, speaking of risks, do you see the risk from rising commodity prices? I mean, after all, India imports most of its oil needs, and that will drive up costs.
Absolutely. So the first thing to look at is that in India's consumer basket, imported inflation is less than 10%. I would say it is closer to 5%. So the direct transmission of higher global commodity prices into Indian inflation is actually quite low. Whatever surprises we have seen over the past year, even in the past month, has all been driven by, volatility in the vegetable supply chain, which was disrupted during the pandemic, and it's now normalizing. So the risk to CPI on the whole is actually quite low. The risk is much bigger on the balance of payment side, because if you're a big importer of energy, every dollar per barrel increase means $1.4 billion a year. Now, and on the balance of payment side, India, before this recent spike in oil prices, was running a BOP surplus of nearly $80 billion a year. So that number is now down to $30 to $40 billion a year. So there is no real risk to the currency. In fact, in many ways, it kind of solves a problem for the RBI because they didn't know what to do with the inflow of dollars. But if oil prices continue to rise from here, then yes, I think the BOP comes under stress. I think a lot of the retail inflation then starts to flow into transport services, because finally, even if petrol and diesel are only about 2.5% of the CPI, the second order effects from freight, etc., can start to seep in. I expect this just to be a reset, meaning the global economy is rebounding faster. Therefore, the 50 has become 70. If 70 becomes 100 over the next 1 year, then perhaps there can be some headwinds.
Neelkanth, like the rest of the world, we've seen how retail investors have been jumping into the market, and that's driven pretty much prices for small and mid-cap stocks. Do you see that being sustained, and do you see risks linked to that?
Yes. So right now the momentum is quite positive. See, if you think about sustenance, if you're thinking 5 years, maybe not. But if you're thinking the next 6 to 12 months, I think so, because even in January, the number of demat accounts, the dematerialized account, which is effectively a trading account, was up 30% year on year. Most of these retail traders have actually seen significant gains over the past year. And therefore, I think the likelihood of them stepping away very suddenly is very low. I think their positioning, their focus is a lot more on the small and mid-cap stocks, and therefore I think there will be a good momentum there. There is another angle here. See, in the listed space, the larger companies are much more about the world. The BSE 100, more than half the revenues actually come from or are linked to global trends. In the small and mid caps, it's actually far more focused on the domestic economy. So as the domestic economy rebounds very sharply and the medium-term prospects improve, I think the small and mid-cap stocks will also have some good earning support. So we do think that they will do better than the mainstream indices, at least in the next 6 to 12 months.